Well, Asian markets trade cautiously amid the renewed US-China trade tensions. This after the Chinese accused the United States of fueling cybersecurity fears. Now, the Chinese government said that the United States is attempting to curtail its technology development by claiming that Chinese mobile network gear might pose a cybersecurity threat to the foreign countries which adopt the equipment. So on the back of those cues, you have the Nikkei that's as flat as can be. Remember, overnight it had, yesterday it had a very, very strong run. It was up more than 1.5%. And the other markets as well that ended with very, very strong gains, in yesterday's trading session. They're giving some part of that back. So the Kospi as well is flattish. And pull up the other couple of markets, both the Straits as well as the Taiwanese index, they have opened up more or less flattish with a bit of a positive bias. What is the SGX suggesting, though? What kind of start are we bracing ourselves for? Well, we're bracing ourselves for a start in the green. The problem's not in the start, but how the day progresses. So at least some green to kickstart trade. We'll take that.
Okay, so mixed views coming in from the Asian markets. But remember, the clock on the US and China trade talks is ticking away as the March 1st deadline approaches. CNBC's Eunice Yoon caught up with Myron Brilliant of US Chamber of Commerce to get a sense of where the talks stand and the progress made ahead of the meeting in Washington this week. Take a look.
Well, this is a critical week. This is the third time the principals will have met. Now back in Washington. It may be cold here in Beijing today and snowy, but the talks are heating up. I think we're at a point where both sides know what the issues are. There's been progress made around some of the purchasing issues, some offers by the Chinese in market access liberalization, for example, in the financial service area, reducing tariffs on autos. That's all good. And some progress, in fact, on intellectual property enforcement, particularly focused around patent and copyright issues. But there's still gaps on important structural issues. For example, around tech transfer, around subsidies, and around a general category of industrial policies that China has adopted that hurt U.S. companies and, frankly, foreign companies' access to the Chinese market. These are still big issues to be worked out.
The Trump administration has said that they want to see a comprehensive plan. They want to see a comprehensive deal, which would include some of those issues that you talked about, structural issues. So how realistic is it that tick, 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 we're going to get that in the next several days?
Well, that's the big question. We only have a little bit of time left before March 1st. 12:01 on March 2nd, tariffs on goods from China will go up 10% to 25%. So there's not a lot of time left. And I do think both sides are working in earnest. I think there's a constructive tone between the principals. Ultimately, this is going to have to get down to a narrow set of issues that the two presidents engage in.
So then do you expect to see the tariffs being suspended March 1st, that we wouldn't actually see the tariffs imposed?
Eunice, it all depends on what the tone of the meetings are this week. If there's sufficient progress between the two sides, I suspect that we will see a delay in any measures taken on the tariff side until the conclusion of these negotiations. But time is ticking. It's important this deal be comprehensive, enduring, and sustainable.
Well, here's some opinion coming in from Mitul Kotecha of TD Securities on the growth slowdown concerns and also the impact on China and emerging markets.
China's growth trajectory is still downwards. There is a reluctance to implement hard and strong fiscal and monetary easing just because of the leverage buildup that's taken place in recent years. I think we're probably now on the cusp of more aggressive easing policy, and that could mean benchmark policy rate cuts. The stimulus on the fiscal side could also intensify because this slowdown, as we've just seen from the car sales figures, is intensifying. And I think China will probably need to do a lot more, especially if trade talks don't work out, then it could be even worse. So I think the reality is the risks are for bigger stimulus. Our view is that growth will continue to slow, but it will be a soft landing, and probably 6.1% growth this year. What we saw was that the market pared back expectations of tightening from the Fed. The dollar reacted to that, and this environment now, we're not really seeing any real ranges now or any direction from the dollar. It's been holding up reasonably well. I think the fact is we've already priced out into a lot in terms of hikes, so that may put a bit of a floor in the dollar in the short term. So we think the dollar could do reasonably well in the short term against some of the low yielders, at least for now. Our overall view on the dollar this year is still more negative. We think the dollar will weaken in the next few months. But, you know, we've priced out hikes. Positioning has shifted a lot. I think a lot of negativity around the data has already been priced in. So you could argue in the short term the dollar will probably hold up reasonably well. Asia's benefited quite a lot from an inflow of portfolio capital, both into the high yielders and the bond markets have done pretty well, and in terms of Asian equity markets, the likes of Korea and Taiwan and equity markets have done very well from inflows. So we've seen quite a reversal of capital, portfolio capital flows. The Fed pivot has meant that rates aren't moving up or unlikely to move up as quickly in the US. Clearly, there's still a question about the balance sheet runoff. We'll see that this week in terms of perhaps what the Fed could say about it in its minutes. But for now, the dollar has been quite restrained.
Well, shifting focus to the European markets, then they ended mixed as the global trade developments continue to remain the key focal point. The FTSE ended 0.25% lower, while the French CAC, that outperformed to end in the green.
Okay, so tepid moves coming as far as the European markets are concerned, but in the currency space, the dollar holds steady against its peers due to lack of direction as the US markets were shut for a holiday. Meanwhile, the Japanese yen gains versus the US currency as well in the morning trade.
Well, in the world of commodities then, oil prices had climbed to three-month highs, supported by Saudi Arabia's pledge to cut its crude output beyond the level agreed with the OPEC producers. The oil market is also getting support from a steep decline in production by producers Libya, Iran and Venezuela, which have been excluded from the OPEC cuts. However, this morning, we have seen that Brent crude prices has retraced close to around 0.5% and trading closer towards the $66 per barrel.
Okay, on that note, we'll slip into a quick break. Up next, we'll get you all the cues and news you need to know for trade this Tuesday morning. Stay tuned.